Dorothy gets hit on the head, wakes up in Oz. Do you feel a little bit like Dorothy? How did we get here? And where do we go next? This is our topic for today. We're going to do some review, look at the past, look at the Wyckoff tools and method, which did, I believe, a great job in helping to identify this very risky environment that we were coming into. But then the next part is, where are we? Where do we go from here? How do we get back to the old world that we know and love? We can tap our shoes and wake up back in Kansas again. So let's get started. First off, very exciting announcement. We have a Wyckoff expert discussion on the coronavirus bear market, Friday, April 3rd, 9 a.m. to noon Pacific time. Now, unfortunately, when you see this recording, it will have already happened. But the good news is that Roman is going to make this recording available to everybody at the Wyckoff Trading Method YouTube channel. And so please go there and on the evening of the 3rd, and you will be able to watch this great lineup of speakers. Humbly, I put myself among these great lineup of speakers. And so these are all just terrific Wycoffians, including Gary Dayton, Dr. Gary Follett, Roman, myself, and the legendary David Weiss. And so this is just going to be an epic day. And the thing is, it's free. So please take the time, being that you're sheltering in place, to watch these great Wycoffian thinkers, presenters talk about the current environment that we're in. Okay, let's get started. We are in the classic environment of a business cycle with all of the elements of accumulation, markup, distribution, markdown. So we are currently in a markdown phase, which leads to a new accumulation. The big question becomes, is the markdown phase completed, or do we have to have a redistribution for another decline? We're going to attempt to address that today. But always in our thinking, we're always considering the conditions of the business cycle and the trading cycle. So as of the end of the year, we saw the elements of distribution, overbought conditions, sentiment or psychology at bullish extremes, and became appropriately defensive. So with that in mind, let's just have a look at some of these charts. This chart I originally showed on December 6th and of 2019. These are yearly bars. So this is the yearly bar of 2019. And at that time, we had, in using classic Wycoffian trendline analysis to create this demand line, this is 1942, this is 1974, and you can see here with an appropriate overbought parallel trend channel created, we said, you know, the market is likely to find resistance at this overbought condition on this trend channel and should spend some time working along this area before it has the ability to climb out like it did here. And in fact, look at this big bar that we have in 2020 that already has a tremendous amount of volatility and has taken out the lows of the prior 2 years. It is back into the range of the prior 2 years, but it has gone below. The volatility is exceptionally high. And so with that, let's consider whether or not we have to go back down to the bottom of the channel. Let's hope not. This is the S&P, by the way. And so here you can see this was the 1962 analog, which we had discussed, and we can see here that creating a trend line over the top, broadening formation, that we had an overbought condition that created a distributional structure for an important decline that was quite dramatic, went down 27%. The current environment actually has gone down more. So here we have a broadening formation. We have a classic reverse use of trend lines, just as we constructed in the 62 circumstances, and an overbought condition here. And from that, there was a dramatic decline, which we have gone into an oversold shakeout position below the trend line. And this is a classic normal, well, again, reverse use of trend line on the decline also. And we've gone below that level. And so with that, what has happened? Well, here's what happened next. And so you can see that there was a after the shakeout, there's been a very sharp bounce back up into the area of the rally or the decline, this rally phase, which we're going to call for the moment an automatic rally. And so we would consider this to be resistance, this area to be support, and would look at this as a range-bound condition. Okay, with that in mind, let's go on and consider that what we want is to identify a cause, and a cause that tells us that the accumulation is taking place and is building a cause for a rising market, something that we could identify and count with point and figure analysis. So if we just had a selling climax and an automatic rally, then we are at the very beginning of a cause building process. Now let's go back just for a second and look at the 62 example. So this decline in 62, which took about 4 or 5 months, built a cause which was able to produce another beautiful bullish uptrend. This is what we hope for, but as of right now, we can't definitively say we've completed the cause building process. And so this is what we're interested in identifying. Our Why Coffee and Tools have done really an exceptional job of identifying the overbought and dangerous condition that we saw at the end of the year. I encourage you to go back and look at some of those early videos that I did in 2020, and also go back and look at the video that I did in 2019, which was a review of the year. I think I did that on December 6th, and there was another one also, but go back and review these. And I've put these up here: 2020 changes in the wind, distribution and reaccumulation, both in January. But here was the initial throw over of this trend channel that goes back to June. 2 point and figure counts that we used in the year. And these two counts confirmed each other, confirming point and figure counts, and took us up to the level of 29,254 here, 29,509 at the minimum here. Well, we went above the trend channel back in January, and this was the internal high in the market. This was the strongest, and the most number of stocks that were participating in the uptrend were in the January peak. February peak showed divergences, which we documented in the videos that you can go back and look at from earlier in the year. The February peak was a real tip-off, but we also did an analysis and saw that there was definite distributional character here in this throwover and in this break. And you can see this break was the biggest break going back to September. And then in the February throwover, there was an attempt to go up, which was like an upthrust after distribution, and then a failure back into the channel. And so here, but this was what was so fascinating, is look at this 29,568 print at the high, which went over the 29,509, which we had as a minimum objective in this count that was taken in August. So we had fulfilled both of these counts, the December 2018 January count and then the August count were fulfilled at this point, right when the market was throwing over its channel. Classic Wyckofffian analysis. Did a really good job. And then we had this big break, which we're all painfully aware of, which was related to the COVID-19 crisis that we're in the middle of now. So here's the selling climax, the automatic rally that we've just defined, resistance, support, and we would expect that the market will trade in this range-bound condition. But what we really want to know is whether or not this fulfills the point and figure counts, and there are some beautiful counts across here that we can take here to here, and there's counts in here that we can take that we want to analyze to help us know where we're going next. Okay, just to take a quick look at Apple, just been a legendary stock, has done a great job. Classic trend line analysis and then parallel trend channel from the highest point between these two connectors here on the demand line. And look at the throwover that we got in Apple right here at the top. We put this chart up in a video at the time. You can see what has happened since. Apple's a very important stock. It's a bellwether for the economy and actually has acted better than most. And so here we can see resistance and support, range-bound condition. And so we're hopeful that Apple can build a cause in here, but we need Apple to prove that to us. But look at this beautiful overbought condition, distributional structure, big sign of weakness here, and then a last point of supply here, distribution. It's done a great job in indicating to us that it was exhausted and distribution was taking place. Here now is the zooming into the more recent environment. This is as of April 1st. It's not up to date. We recorded this on the 2nd, but just to show you that using here 15-minute data, that there is a distribution type structure that was brewing after the low was put in at around 18,200 in the Dow. You can see this is the automatic rally that we identified right through here. And look at this beautiful climactic thrust at the end, which created the exhaustion. And then there was an attempt to test it here. So you can see beautifully the circumstances show up for distribution in the intraday condition as they do in daily and weekly. And now let's go take a point and figure count. This is an attempt to ask the question, what comes next? And so you can see here, and also we're going to take this count right across here in a minute and look at that. But this count, the gold line, takes us down to 17,134 to 17,000. And I think that's the conservative count that I would work with. I did take the bigger count, goes down to 15,393 at the extreme. But let's focus on the 17,000 to 17,134 and this is again 5-minute data, and coinciding with that 15-minute chart that we just looked at. Now, here, just to show you, this is the count that we have that goes up to 22,000 plus right here. Well, this count 22.9, this count here didn't quite make it. It got very close. It didn't quite get there. I think that's a little bit of a bearish thing. When you don't quite make your point and figure counts, that is a sign of internal bearishness. But nonetheless, that's not a big deal, but it does say that we were probably in an automatic rally and there's going to be an attempt to go down and retest the lows. And this low here was at 18,300, 18,250, 18,300 right here. So remember that we have this count now that goes down to 17,134. And oh, notice this, 17,200. Now, this is a 60-minute chart. Look how beautiful this distribution structure is. And the big sign of weakness that occurs on this first break, which also is followed by a last point of supply. And so this last point of supply, which is really an excellent place for short sellers to get busy, throws over this high by one box, then fails and cascades down lower and lower. Well, this count to 17.2 is another indication of where we could end up going as a potential further low. Now, oftentimes when accumulation is formed, the climax low, which we're going to say is at around 18,200, can be exceeded on the secondary test. So it's possible that we could have a lower low on the secondary test and still call it the structure an accumulation structure. And so if we do get a lower low here, and we'll be on our toes about this because it's always possible that a higher low could be made in an accumulation because we're putting support here and resistance here. And so we would look for a cause to be built, but it wouldn't surprise us if a lower low was made on a pullback to the secondary test level. So let's keep that in mind. Now, here is another point and figure chart, and I want to show you that this count is using traditional daily data 3-box method, 250 point scaling. And if we count all the way across to the May peak, April-May peak in 2019, we get a count that goes 19,750, 17,250. Well, look, we've gone to 18,250 here and then bounced. And so 17,250 is still the extreme low count of this, what I consider to be a traditional counting method using daily data. So you can see here 18,250 is where we went, and then here's the bounce, automatic rally kind of material. And so here we are at the 17,250 level as our extreme, and that supports the intraday count that we just looked at a minute ago. Well, where is that count on this big chart? So here's our last point of supply, and we're going to go back and count to that April-May peak, which is right here. So this is the count. You can see this is a substantial count. So all of this we're counting as distribution from April all the way over to this upthrust high and the last point of supply. And this is this area right here. And look how beautifully this count worked. And it produced 9,750 points of potential in this decline, and it's fulfilled it. So here we go. Okay, so here are some notes. I'll let you pause and look at these notes, but potential selling climaxes occurred and an automatic rally. We're likely in a range-bound condition. You can see resistance and support. Point and figure objectives reached, so that's very important. Possibly we could make another minor new low. hard to imagine, but 1,000 points lower on the Dow, 17,200, could be considered a minor new low. But look here, secondary test area right there. So a decline through the selling climax is not uncommon, especially when you have the severe downward momentum that was created in this decline. It's hard to stop a decline like that. And so this is the reason we search for a cause and we're patient. We want to wait until the cause is complete and not get beat up by the volatility that can come in and the surprises, because we know that there's more bad news ahead in the economy as we go into the second and third quarter. And this bad news is not just going to be related to COVID-19, but it's also going to be related to economics, unemployment data. There's going to be some bankruptcies. And there's just going to be generally more and more bad news. Well, the thing is Wyckoffeans, we know that accumulation's complete as the bad news is the worst. And the bad news can be even become more intense after accumulation is complete and the uptrend has started. And that's where we get the term climbing a wall of worry, is because the bad news is getting worse, but the market's going up. That's the reason we want to stay focused on our Wyckoffean skills, our Wyckoffean accumulation capabilities, and understanding where those are completed and how uptrends begin. And so this is what we're going to be doing together. This is what I'm going to be doing in these classes with you in power charting, is identifying these conditions. So watch for diminishing volatility into the secondary test, So there could be more than one. The first one could look very volatile, which is declining below the 18,200 area. And then the secondary test could go lower than the selling climax, and that it would be bullish if it was higher. So let's hope for that. But nobody ever gives me a vote on what the market decides it wants to do. Okay, so here is the S&P, same counting, going back to the April-May peak, counting across, and you can see 2,300, 2050. We may have to go to the 2050 area or below. People, and notice this, we did go to the 2,200 area, so we did fulfill the objectives down into this area, had a rally. We may have one more test down to the lower level. We have to be prepared for that. Okay, so this is the last slide. Good timing. Now, I've shown you this slide before, presidential election years, and originally we were looking for a pause in an uptrend and a reaccumulation structure for another leg up. But because of what's happened, which we have just discussed a minute ago, this decline here, which we said would be a scary decline at the time, a buying climax and an automatic reaction, has turned out to be mega scary. And so and this is the alternate universe, like our hero Dorothy has gone through being in Oz, is that we're looking at a really crazy decline related to a stopping of our economy, which is quite remarkable. You can see a little cause build here, but notice this peak came in January. Well, actually, we're going to say that the peak came in February, and as we're coming into the end of March, the end of the first quarter, we're seeing a low that's been put in at the end of March, which not surprising. End of the quarter, we look for highs and lows. And now we're looking for a cause to be built for a rally. So what we're suggesting is, and here you can see distribution, we're suggesting that the peaks and troughs are about a month delayed. And so we would look for a potential new low here as on a secondary test in early April, and then a rally that would take us up towards, it's not going to get up to the highs that were made in January, February, but some kind of a rally after having a automatic rally and a secondary test. We would look for another rally to occur, but then followed by another reaction that would take us into the end of the second quarter, end of June, early July. And hopefully we will have determined that this whole area here is in fact let me clean this off. This whole area is an accumulation structure that can build a cause on point and figure work that could result in an objective of higher prices. Not likely that we'll get anywhere near the highs that were made at the end of 2019, beginning of 2020, at least in the year. Now, maybe later, but we know that the Federal Reserve has flooded the system with liquidity. Congress has done a fiscal package that is put trillions of dollars into the economy, and interest rates are on the zero bound. So there is just all of this liquidity that's being pumped into the economy. But I would suggest that we're going to see tremendously bad news in economic conditions, and hopefully not as bad in the COVID-19 epidemic, but that we're going to, on that bad news, complete an accumulation. So with that in mind, here are two accumulation schematics that we can look at. And these two accumulation schematics are what we would look for completion in. We're right here, selling climax, automatic rally. I do believe we're going to get some kind of a trading range type structure. You can see here the secondary test goes below the selling climax. This might be the 17,200 level that we are seeing in a number of point figure studies. We've seen 3 of them that go there. And then another rally. This might be the May rally, and then the June-July low, which could either come as a spring and go below the levels of the secondary test and the selling climax, or could be more bullish and be a higher low, a last point of support that then introduces a big bullish run into the fall. And this is a wish. We forecast for fun. We'll know it when we see it, but for the time being, this is what we're waiting for. And in the meantime, we're going to stay low to the ground. We're going to stay defensive. We've been defensive since the beginning of the year, and these Wyckofian tools have done a wonderful job of protecting us and keeping us in a safe place so that we can then redeploy capital back into best leadership ideas when the time comes. And these are the things that we'll be talking about as we go further into the year. So with that, this is our review, and thank you for being here, and we'll see you again next time. Take care and stay safe.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.